is Sky News Real Estate. Smart Investing.
Hello and welcome to Smart Investing. I'm Chris Gray. Coming up, is it still possible to use the equity in your home or investment property to buy further properties, or has APRA and the bank shut that option down? Is it safe to be borrowing 105% of the purchase price when buying property? And if you want to progress in property development, how big a project should you start with? Well, joining us tonight is Rob Southwell, Managing Partner of Pitcher Partners Accountants and Advisors, and Charles Tarbey, Chairman and owner of Century 21 Australasia. Welcome to the show, guys.
Well, evening.
Now, obviously, we've heard lots in the media the last year or so about APRA. So, is it still possible to drag out that equity, or are the banks just asking too many questions, Rob?
It's still possible. So, like most things, you've got to get your ducks in a row, and you can use existing equity to go and buy new property. But you, as I mentioned, you've really got to make sure that you've got all your ducks in a row to do that.
Yep. Now, Charles, as well as your real estate business, you've got your mortgage company as well, so you're on the pulse of all the brokers out there. It is getting tougher and tougher. APRA have been giving everyone a lot of grief. I mean, it's hard enough to get it out to use it for equity as deposits, let alone trying to have it as living expenses or paying off credit cards.
It is incredibly different than what it used to be like. You can still do it, as Rob says, but it's incredibly different. And because of the investigation that's going on right now, every banker that I've spoken to, because I've been speaking to a couple regarding some more business developments I'm doing, they are looking at it in a totally different way than they might have normally, even though I've done business with them before, because now the affordable lending issues are real and people are watching that very closely. I know people with equity that can't borrow right now because the ability to repay and meet the standards, and those standards have changed too with regards to the percentage of salary in terms of your gross income over repayments. That's been the one that I've noticed they're watching very, very closely now. So it's there, but as Rob said, you've really got to be lined up nicely this time around.
Now, there's a lot of seasoned investors out there that think, hey, this is a whole bunch of rubbish, leave us alone, we're more than capable of dealing with it. But literally a 30-second clip I saw before was a gambler saying, I didn't want any more credit, the bank kept pushing up my credit card limit, and I got more and obviously I spent it. So I guess that's what they're trying to protect, the extreme cases where people maybe aren't in control of their money.
And generally that's what it is. It's always that minority story you hear about that changes the rules for most who are out there. Look, when I bought and sold real estate, I wouldn't advise other people to do what I did in the early days. You know, I was a young bloke, I went out and bought real estate. If I could borrow 100%, I would. At the end of the day, the reality was for me, I took the risk, I took the chance, I signed up for it. If it worked for me, I benefited from it. If it didn't work for me, I paid the price, and that's simply it. But, you know, investing is no longer in the hands of the investor.
Yeah. Rob, you brought some examples with you. We'll pull up a graphic on the screen. Do you want to take us through the numbers? Because we still get a lot of viewers ringing saying, I just don't understand how you pull the equity in, how you effectively borrow 100% as well.
Sure. So if we pull up the first slide, what we're looking here is, say you've got an existing property that's worth $1.5 million. You might have some outstanding borrowings against that of, say, $800,000. So the bank will traditionally lend you 80% against that. So there's, you can lend up to 1.2, which means you have some available equity in that property to use to help you go and finance another property. So the way this works on a basic level, if we move to the next slide, say we want to go and buy an investment property worth $500,000. The loan, again, the bank will hopefully lend you 80% on that, which means that you're left to fund with costs around $120,000. So what you then go and do, if we move on to the next slide, is you offer up both of those properties as security to the bank. You then now have $2 million worth of property or available LVR of 1.6, and then so it's still within the bank's parameters. And then if you move on to the next slide, you then see the resulting that you've then gone and used that equity that you have now to basically increase your property exposure. So on a very basic level, that's how you do it. But as Charles outlined, it's not just about the LVR, it's also about the serviceability. But that's how you take the equity in your own home and bundle it up together, or existing property, to buy a second investment property.
And Charles, obviously if people aren't too much into the finances, this can still be very confusing to them. this can be an easy difference between whether you go to a bank or a broker. Is you go to a bank, they say, buy a home, pay it off, come back in 25 years. Most brokers are more used to dealing with this kind of conversation, aren't they?
They certainly are, and this incentivisation of brokers, which has also become an issue with regards to the bank inquiry, you've got a minority that have caused some issues out there. And the banks weren't watching it, some of the banks weren't watching it, and it's hard. Look, there are not too many businesses out there that know 100% of what's going on in every corner of their business every single minute of the day. So what happens then, all of a sudden, the whole industry gets brought into this, and I want to go out and legitimately borrow some money. So this is what I'm doing right now. I legitimately want to go out and borrow some money. And the bank goes, yep, all the equity's in place. Now, let's talk about the serviceability. And the whole game changes straight away. It changes, and again, I used to be able to do this, you know, standing on my hands. Or you've seen me.
I know you've seen
me standing on my hands.
I've seen you do that in a restaurant in Sydney.
Don't bet against me. And I wasn't drinking either. The issue is that it's caused a few problems for a few people, and it's again like everything, the minority rule. And the majority suffer in the process. There's been a lot of issues with certain banks and brokers that have done the wrong thing, and I don't think that'll ever change. But when you go into it and you change the entire rules for everybody that have even got a history in buying and selling, negotiating, repaying, never had an issue against them, they can't do it.
Yeah. And that's where old school's out the window. It's all new school now and following the rules. Rob, does it make a difference if people are borrowing for investment properties or for their own homes when it comes to serviceability?
Yeah, so obviously the main differential there will be the fact that with an investment property you've got extra income coming in, so the bank will look at that in assessing your serviceability. But what they don't do, you would think, well, I'm getting $500 a week, I'll just take the $500 a week and they'll include that in my ability to service the loan. They don't. And at the moment, given that every bank is different, they all use different ways of doing it. Rule of thumb is usually they will take something between 70 and 80% of the estimated rental income, or they'll just apply their own rate. So they may apply a rate as low as 3% of the value of the property, and then they include that in your serviceability calculations. Obviously, if you're buying your own home, there's no income coming into that, so the serviceability hurdle is probably much higher. And then they will, traditionally they have also looked at if you're negatively geared, they quite often include the tax benefit in that. They've stopped doing that probably over 12 months ago now, and a whole range of other issues. So, and then obviously included in that, then they'll look at the rates of interest that you're borrowing. So obviously, investment loans are typically much higher than owner-occupier loans. So, again, you're being assessed at a much higher rate of interest.
So it's a whole juggling act. And, again, this is where normally a broker or a decent private banker that knows what they're doing can say, based on your whole situation, you're better off going to this bank because this bank will take your tax, won't take your income, and they'll mix and match.
I should have answered your question before, because with a broker they're incentivised is what I was trying to say, and incentivisation changes the rules. People work harder when they're incentivised, and that's why brokers are often better than just going straight to the bank, because there is that solid incentive, which has unfortunately pushed some people over the edge the other way.
Yeah.
But the majority of brokers out there know that competition's competition, and they'll do what they can to get your business.
And it sounds like in any other business. Again, part of this 30 seconds I saw on one of the news shows was someone asking the question from the banks, well, are you going to profit out of this? Well, yeah, that's why we're in business. We've got to pay our wages, we've got to pay for our mortgages as well.
Yeah, exactly.
And again, you need someone with an incentive. If there's no incentive and you're a hard case, they're just going to leave you alone.
A broker recognises the differences. Often a bank will have a guidelines that they'll sit with, but a broker can manoeuvre around a significant number of bankers, because each one of us has that different thing. I noticed sitting here that for people looking out there, all of our heads are at the same height.
We all look as if...
No, your feet are touching the ground and mine aren't.
Actually, they're a bit higher.
So we all have that. We all have something different going on, and I think that's why a broker is good to have around.
Very good analogy, Charles.
Thank you.
On that point, let's jump to the auction clearance rates.
Okay. Well, they've been pretty interesting for a while. The clearance rates have been sitting in the 60s, not much changed. It was 65.5. This time last year was 74.5. So you can see that the difference is significant. 9% is a significant difference. Did I get that number right, or is it 11%? Anyway, 9%. 9% difference between this time last year. Sydney, because we got the long weekend coming up, Sydney had 1,359 auctions, which is massive for Sydney, 66.2% clearance rate.
Big Saturday, they call it, don't
well,
they?
Melbourne had a clearance rate of 67% flat, and it had 2,078 properties go up for auction. Now, the best performing capital city was Canberra, 73.8, but the best performing capital city overall and over this time last year, there was only one. It was Adelaide, 67.3%, and it was better than this time last year with more auctions. And I think a lot of people are now saying to talk Adelaide, which we've talked, Adelaide and Perth are our two sort of picks.
They love getting you mentioned down in Adelaide.
They do. Well, somebody complained the other day I didn't talk about Adelaide enough, and I thought I did. But anyway, that's been one of my picks for some time.
Wonderful. And are we getting many properties up for sale?
No, it's been a bit slow with that, but only relatively slow. A lot of people are going, oh, gee, maybe it's time now. This is an assumption, obviously. Maybe it's time to not put the house on the market because there's more stock. So it was down 0.44% over this time last week in terms of growth, but the amount of properties we have for sale is 4.55% higher than this time last year. So, and also the auctions that went in last Saturday were higher than this time last year as well. So there's still a fair bit happening, but there's not as much interest. There's definitely not as much interest. So the agents are trying to negotiate before auction again. And
again, that could be the perfect time to put your house on the market if there's nothing around.
If there's
sometimes people want it when everything's on the market. So there's arguments both ways, isn't there?
Certainly is.
How about rental price?
Yeah, not a lot of change there. It's down over this time last week, 0.92%. But I was looking at it. We started this chart, would have been 2.5, 3 years ago after started the chart, and we are up 5.77% on that time in terms of rental across the nation. And the ones that started to climb were Hobart. That's starting to have a reverse now. So it's been dropping, was in the 10s up there for a while, it's now back into the 9s in terms of increases. So it's coming back, which I expect it to. I really think it will, because I think all of those properties that come on the market there soon from investment sales will start to bite.
And then just finally the vacancy rates.
Well, Melbourne has been the king for a long, long time. It's just outstanding. 0.44% last week vacancy rate in Melbourne, 1.65% in Sydney, and Perth jumped. Perth was 6.97 last week from memory. It's up over 8.06%, 3.38% for the three average. But still 8% is high, but it's a lot better than what it used to be.
Wonderful. Thanks for the numbers, Charles, and see you again. We won't see you next week for Easter, but we'll see you the week after.
Well, okay, thank you.
Wonderful. Well, coming up, we'll examine the ins and outs of property developments, and always a reminder, you can get a free digital copy of my book, The Effortless Empire. Just go to yourempire.com.au. Now, we're going to take a short break, but we'll be back soon.
You're watching Sky News Real Estate. Smart investing.